Welcome once again to the BizLife Podcast. We're recording from the Small Business Education Program Studios in lovely Las Vegas, Nevada. We're part of UNR Extension, and we're here today joined with my co-host, Carlos Gomez from the Latin Chamber of Commerce.
Oh, thank you for having me. Thank you.
Thank you. Glad you could be here with us today. And today we're going to be talking, we have our special guest, Walter Flores from New York Life is going to be on here with us.
Yeah, thank you for the invitation, guys. Thank you again. I think it's a great thing that we're doing here, bringing the information and education to all our listeners in there and population in general.
Wonderful. And Walter's with New York Life, and you want to tell us a little bit about yourself and your career?
Absolutely. Well, I've been with New York Life for over 4 years. Mm-hmm. I've been on the financial industry for over 5 at this point. One of the things that motivates me to start this career, it is bringing the information to mainly my culture, people in general, but I like to focus myself on be the special people, say like the people to go to or the to-go person for planning for the Latino business owners in there. So I represent a couple of restaurants in here in town, and pretty much I do planning for them so they get ready when they getting closer to retirement or how to prepare for retirement as well.
Exactly. Yeah. Well, we know that the Hispanic community in general are great entrepreneurs. They really are. They a lot of them that come here, they may come here to this country and they start businesses. They just do, and they hustle and they work and they start businesses. And sometimes, we get them 3-4 years down the road and we go, hey, you missed a couple steps. You probably should have set this up and this up and this up, and then they usually do. So that's a really good thing. So that's part of why we're here, is making sure that everybody's informed and everybody can have the educational experience that they need to be able to run their businesses better.
Yes, and also we need to take in consideration that many of those entrepreneurs come from different countries, Mexico, El Salvador, Guatemala, Argentina, and so they don't know the system. And so when they come, they know the value, how to make money out of the $1. So they are really good at it. But they don't know the system, the American systems, and how they can rely on the American system for the future.
Exactly.
That's right.
And they may have come from countries where the banking institutions and the financial institutions are not as regulated or sound as we have here.
Correct.
I hate to say sound. Sometimes that sounds awful, but right, Carlos?
It's not the same system.
It's not the same. They're different. They're different. They're different. So we could say that. So sometimes that is a challenge, but that's why we're here, is to make sure to educate our business community. So let's talk about some retirement options now.
Absolutely. Well, I always like to start my conversation with most of my clients so they understand the analogy that I'm going to say right now. Okay. Say something that Carlos and myself are in the farming business. Okay. And I said to Carlos, let's just go and plan for an orchard down the future. Let's get some seeds. Let's buy some seeds right now that we know when that investment in the future, 20, 30 years from now, is going to worth $1 million. Okay. So I tell Carlos, what will you prefer to pay taxes on? Will you prefer taxes on the seeds? Or will you prefer taxes 20, 30 years down the road when that investment is worth millions of dollars? Okay? And that is when a lot of people tell me, like, of course, I want to pay taxes on the seeds because I'm going to save some money that way.
Exactly.
But I'm going to be disciplined to do it down the road. Okay? So that analogy will be very useful for the following topics that we're going to touch in there. And again, it's not right or wrong planning, because everybody has different needs and different situations that accommodate their planning according to that. As one of my favorite authors says, Robert Kiyosaki, probably we all here
love Robert Kiyosaki.
Yeah. On the book Rich Dad Poor Dad, it is one quote that it says, like, most people fail to realize that in life, when it comes to money, it is not how much money you make, it is how much money you keep.
How much you keep.
Okay.
Exactly.
So a lot of people fail to understand that principle in there. So, and as we know, one of the biggest things that can affect our money in retirement or any planning in general.
Your wife.
Besides that, I'm just kidding.
No, Carlos. That can be a factor, right? But
It can be.
I don't think that's what he was going to say. I don't think that's what he was going to say.
No, it's like spending habits. No, I'm not that. So one of the things that can affect your money when we're planning for retirement or money in general are penalties and taxes. Okay?
Yep.
So we have to plan according to that. And for that reason, we have two different type of investments that probably we heard of it, but we don't know what they mean when they talk about it. And we have the different type of investments are what they call qualified taxes or qualified plannings, and also a non-qualified tax. Okay. So qualified taxes, just to keep it simple, and we're going to talk generalities because I would love to talk about all these items with you on a regular basis, but we're going to be here for a couple hours if we start talking about it. But qualified taxes is a type of plan that the money that we put away has not been taxed yet.
Pre-tax money.
Okay, that is a pre-tax money. Okay. So that means that it helps us most of the time to reduce taxes now. Okay, again, something.
And hopefully later.
Yeah.
We don't know.
We don't know. Correct. So and that's why these certain type of employer plans offer this type of planning, and what they tell you that you can do a pre-tax contributions to save taxes now. Okay, so that way your account, whatever your account is, that the one that you have, it get tax deferred. What is tax deferred means? That you're getting like a compound interest, like you're getting taxes over taxes on that plan. But it comes when it comes the time that you can start taking money or taking distributions, they call, you're going to pay taxes later. At what rate? We don't know.
Well, hopefully you're retired at this point and you don't have a principal salary coming out.
Correct.
Or maybe you're partially employed. Hopefully your tax rate is lower at that point, in theory.
That is, in theory, that's what he says. But a lot of people says like, hey, and that is an old mantra that a lot of people uses in there. Because all these type of plans and taxes, and I'm not saying they're bad. It was very popular in the 80s.
Yep.
In the 80s and in like close to the early 90s in there. Why? Because the tax rates were close to 60, 70.
Mortgage rates were 16, 17%.
Yeah, 17%.
Correct.
Yeah.
So at this point, the mantra was helping, saying like, hey, I'm going to help myself saving taxes now, that when in the future, I can save some money, as you said, later. That it works if they're retiring nowadays.
Yeah.
But for future generations, where do we think the taxes will go? With all the debt that we have, with all the different uncertainty in the market, so that's why one of the things that I said, like, where do you think the taxes will go in the future? Will they go higher or will they go lower? Okay, so a lot of people tell me, like, of course they're going to go higher, and so why are you saving a lot of money in taxes now to pay God knows what rate in the future? In the future. And again, it goes situation by situation because it's not bad or wrong planning. Okay. Other things that determine this type of plans, guys, it is that they have limits on contributions that you can do per year.
Yes.
Okay. So even if you say something, you're a successful business owner and you want to put a lot of money into that, these type of plans, it tells you like, hey, this one is the limit that you have. You cannot put more than that. And we're going to talk about those limits a little bit down the road. But this one, it will tell you pretty much the limits of contributions that you can do. Okay. Other thing that a lot of people don't know, and especially now that we have close to 81 million baby boomers that are in the verge of retire or they're already about to retire, it is the different rules that these plans have or had in the future. One of the most popular, as a lot of people know, it is like, hey, you cannot touch, or we don't recommend to touch this money before 59 and a half. Okay? Why? Because if you do so, IRS is going to penalize you with a 10% fee.
Yeah.
And on top of that, because you never have paid taxes on this type of planning, you're also going to pay income taxes.
Income tax, yeah.
So
It may cost you 30%.
correct.
Right out
Easy.
the door.
Easy.
33 and a half.
33 and a half.
Oh, it sounds like somebody has experience on that. so that thing, and the other major thing that it is recommended for people that they're listening to us right now, or sons that they have parents that they're on that age in there, and a lot of people don't know, it is what they call the required minimum distributions, or what they call the RMDs. You know, a couple years back, the age was 70 and a half years. Not anymore. Now with the little changes they've done last year and a half ago, they said that now that age is 72 years.
Okay.
Okay. So now the IRS is probably one of the highest penalty plans that they have, because it tells you like, hey, Carlos, I give you the opportunity to defer taxes all this time, but it's now time that you can start taking money out. If you don't do so because you don't need it, because you've done great in your business and you want to leave it as a legacy, if you don't take the amount that corresponded to you on that year, I'm going to penalize you with 50%.
Wow. It's 50%? That gets the
50.
buzzer.
Yeah.
50. So imagine that, because say something, you have $1 million in there, and the amount that you need to take out at that point is $50,000, just to put a number.
Yeah.
If you don't do so before April 15, if I'm not wrong, of that year, you're going to pay 50% on that amount that you're supposed to take. So you're going to lose right off the bat $25,000.
Wow.
Okay? So, again.
Carlos looked at me and says, hit that buzzer again. Okay, I got it. I got you, Carlos.
So, and again, that is when we're contributing to these plans, we have some restrictions or some exclusions that we can touch this money for emergency, adoptions, buying first house, or things along those lines that we can use for it, like even to study or view either yourself or your kids. They give you up to $10,000. So it's some of the exclusions they have in there.
So there's three types of qualified plans, right? There's IRAs.
Yes.
Right? Simple IRAs. There's traditional IRAs, simple IRAs, and then the SEP.
Correct.
Plan.
Correct. That is some of them. Some of them, when it comes to qualified plan, if we're talking about individual retirement accounts.
Okay.
But there are also some retirement accounts by itself, that they're qualified as well.
So what's the difference on those three types of like traditional, the simple, and the SEP?
Okay, so traditional array, and then we're just gonna give you basics in there, because that is a lot of info. A lot of information that I don't know if the time that we have today will be enough to talk about it. But one of the things is that traditional IRA, what does IRA stands for? Individual retirement account.
Yeah.
Okay, so this retirement account accumulates tax deferred to as well, similar to the example that I was putting. You're not paying taxes on the gain now, but whenever you start taking distribution down in the future, you're going to pay taxes of whatever rate we have, or whatever income rate that we have. It all depends on if you get offered a qualified retirement plan through work. You may or may not deduct the contributions on these plans on your taxes. What do I mean with that? This, you say something, you are married. Okay, Carlos, you're married. You're both are working, but you have, they're offering you whatever you're working, a 401k, and your spouse is not. Okay, they doesn't have a 401k or any retirement plan on her side. You both can contribute to this retirement account, but the ones that can deduct from your taxes, it will be from the spouse that is not participant on any retirement plans at work. So in that case, it will be your wife. Okay, but if none of you say something, you are business owners, and you don't have a specific 401k plan that you set it up down before you start planning all of this, you can both contribute to this retirement plan and deduct it from your taxes.
Okay.
Okay. They also have limits. Okay. What do I mean limits? The deductions.
One wife or two wives?
It all depends where do we do the planning. Right? Yeah. No, so
wait, is one at the Prada store and the other one's at Gucci? How does that work?
Chanel, something
Chanel.
like that. Right?
I have the Chanel SEP IRA. Yeah, great.
So what do I mean with that? you have limits on the annual contributions that you can make. So right nowadays, it is $6,000 for people under 50 years old. And if you're over 50 years old and you have an income, you can put up to $7,000. Okay, that might change down the road. Why? Because they most of the time they adjust this contribution limit to inflation. Right now, we know that inflation is a little high. Some of the other plans that we're going to talk about, like SEP or Simple, they adjusted last year.
Sure.
But this one, it stays the same for the last 2 years.
Okay.
Probably next year will be a little higher depending on the inflation rate that they decided to adjust it to.
Okay.
Okay. Here's the other plus on this one. Say something that you're working, Carlos, and you're a business owner, and you made a good planning when it comes to taxes, but you're the only breadwinner of the house. Okay, you can contribute to your own IRA, and you can also contribute for your wife's IRA.
Look at that.
And you can deduct from both. Correct.
No, what I hear is a losing proposition everywhere.
This sounds great.
It's not a win-win, right? So that's pretty much on the nutshell what is a traditional IRA. They also have limits of, like say something, if you make too much money and you're participating in one of the employers, you cannot deduct these contributions that you make for yourself on there. And those numbers are $68,000 for single and or head of household, and $109,000 for married or filing together.
Okay.
So those are going to be the ones, and that one, it will be more like in the individual side.
Yeah.
Okay.
Walter, this type of contributions, retirement accounts, individual or through your company, it doesn't affect your Social Security. Am I correct? Your Social Security benefits.
Oh, no.
Because that's the audience need to know, because they say, well, wait a minute, what about my Social Security? It depends, affects my Social Security benefits or not?
As far as benefit, it doesn't. It doesn't. But what it may affect it is, like, say something, if you've done good for yourself in the planning for you and your family or your wife or pretty much whoever you're planning to, if you start taking distributions of that plan that you've done so well for all this year, and on top of that, you have your Social Security, it is not that you're going to lose or miss any benefits that you have from Social Security. It's like at the end, you will have a higher income tax to pay. You know, because you never pay taxes on this traditional plan. Okay. So it's not that it will affect or favor Social Security. It's just that the taxes will go.
Well, and sometimes if you work for a government entity, a municipality, a city, a state, that type of thing, you don't pay into Social Security in those jobs. And so a lot of these, we'll talk about the 403B probably in a minute, but a lot of that can influence, because if you're not paying into Social Security, that changes stuff around a little bit.
Absolutely. Yeah, but usually they offer some other benefits.
There's some other benefits,
They may give you a higher contributions on your behalf, or they will match you a little higher percentage than any other company will. So it will give you just a rough idea. But we're going to roughly talk about that too as well. Simple IRA, okay? That is Simple IRA and SEP IRAs are pretty much focus more on business owners.
Okay.
But they have restrictions as well. Okay. What do I mean with that? Simple IRA, it is a saving incentive match plan for employees. Okay. So as a business owner, on this plan, you can enjoy the tax deferred portion of these plannings. Okay. You do pre-tax contributions that help you reduce the employee taxable income and owner, because you can plan on that too as well. But one of the things it is that all these plans, if you as a business owner say something that you have 50 employees, Carlos, okay, and those employees, you want to put this plan for you, all these employees are immediately vested, okay? So it doesn't have any restrictions. It doesn't.
You don't have to wait 6 months to a year or anything.
You are immediately vested. Okay, And this one, it has what they call a no discrimination testing. So that means that you can say, I want to put this plan on this person, this on the other one. It's not like some other plans that is either you put it in all or nothing. So you can
choose which employees
choose.
Or you can say management's going to get a certain type of plan.
Correct. Or seniority.
Yes. Yes.
Correct. So you can do it in here. So these plans are focused for employers that they have 100 or fewer employees under their wing. Okay. This one also give you the restriction that you cannot contribute to other qualified plan. So if you got a simple IRA for you, the max contributions that you can do, that last year was less, but this year on 2022, it is $14,000 per year, which is not bad.
Better than the 6,000 or 7,000,
Yeah,
right?
Correct. So, and also this one, but here's the caveat on this one too as well, that you as an employer have to either match dollar for dollar on whatever contributions the employees do up to 3%, okay?
Okay.
Or you can say, you know what, guys? I'm not gonna give you dollar for dollar, but I will give you 2% across the board. Either you participate or not on these type of plans. So
Interesting.
You have either option too as well, and they also have what they call catch-up provisions, which is similar to the IRA that I told you that you can put an extra $1,000 in there.
Yeah.
This one, it gives you the chance to put $3,000 more.
Wow.
So
Okay.
if you're over 50, you can put up to pretty much 17,500 because there is a couple things that you can add into that. So that's what it comes to. Simple.
Quick question, and just to qualify this, you can have as many IRAs as you want to. However, if they're qualified, you can only put in the 6,000 or the 7,000, depending on your age. Correct?
Qualified and non-qualified.
And non-qualified. So you
non-qualified.
still, so if you have one you set up with Fidelity, one you set up with
Vanguard, or
the combined total can only be that 6,000.
correct.
Okay.
Or
gotcha.
7,000, whatever
Or
it is. So you
7,000.
can have 3, 4, 5 different IRAs.
It's not
because-
per account.
No, it is
Okay.
not per account. It's per individual.
Yeah,
Good
that's
yeah.
good for us from Mexican because we had like 6 different names, so there's no problem for us.
Yeah, no, it's true. Like they always confuse me too as well.
Terrific. Well, let's talk about SEPs.
Yeah, SEPs, IRAs.
This is important for all you business owners. This is important.
Correct.
Okay.
So we're talking about simplified employee pensions. That's what
Okay.
SEP stands for. This one, it also provide you with employer tax defer, so you can still not paying taxes on your gain until you pretty much retire. But this one allowed flexible employee contributions.
Okay.
What do I mean? So they can participate, they cannot. It's up to them. But here is the thing that you must include as a business owner, you must include all employees who are 21 years old that has made within the last, you have paid them $650 the last 3 years out of the 5 that you then. So if they have worked for you, say something 1 year yes, 1 year no, 1 year yes, 1 year no, within a 5-year span, if they have made or you pay them $650,000, $650, sorry, not thousand, $650, you will have to contribute to these plans. Okay.
Interesting.
And
Okay.
these ones right here, you will have to do it pretty much across the board.
Okay. So it's for all employees or none of the employees. with this.
Correct.
Okay.
So one of the things too as well here as a business owner, he says like, how do I benefit myself putting these plans in there? You can do 25% of the employees or as a business owner of your compensation. Okay. Or what is pretty much a limit up to $290,000 in there.
Wow.
Or $58,000 that you can pretty much deduct from your taxes, which is a contribution limit. And let me put an example because that is when it gets a little bit confusing in here. I had a client. The client is a very successful client. It has an LLC. It is being tax as an S corp. Okay, LLC is making $500,000.
Okay.
But on his W-2, the accountant works some magic and is just paying $100,000. Okay? So what is the max that he can contribute into this plan? Even that the limit contribution is $58,000. Okay? And probably he makes a lot more to contribute that $58,000. The max that he can put in there, it is 25% of whatever he declare
Of the
on his
100,000,
W-2.
right?
Correct. On the $100,000.
Okay.
So, and because I
And that's a huge benefit.
oh yeah,
The law allows, especially, we know entrepreneurs, a lot of times we're putting the money right back into the business as we're growing it.
Always.
And quite often entrepreneurs, when they come time to retire, hopefully they've bought a building or they've bought something. So when they sell maybe they can't sell the business. Maybe they just sell their assets, but maybe they have a building. If they have a building, they'll be okay. They can sell something there. But this is a way that allows them to sock some money away. If they have some good years that kick up in
absolutely.
here, you can establish this. And let's say you're only employee you have in the business. Terrific. So you're structured as an LLC, getting taxed as an S corp. You can be on payroll. Isn't that correct? Yeah. So
it is a lot of benefits.
as long as you're not a sole proprietor, you can't put yourself on payroll as a sole proprietor. But as long as you're structured properly and you're doing this properly, you could traditionally catch up. If you're taking $100,000 out of the business for your compensation, you could put 25 of that in per year. That catches you up very quickly.
Yes. Correct. And that is an advantage too as well, because that is when it starts the conversation too as well. Which plan is the one that it works the best for me?
Helps me the most.
It helps me the most in there to stash more money for my retirement. It can be a SEP, it can be a simple, it can be a 401k, a solo 1k. So there is many different ones.
Your wife can be on payroll too, Carlos. So
Again?
Again. Otra vez. Yeah.
So that's pretty much when we're talking about non-qualified when it comes to retirement plans, to individual retirement accounts in there.
Okay.
So now we're going to talk about pretty much retirement plans that they are still qualified. Okay. What this means? So retirement plans, we are all familiar with the famous 401k. They said they offer me a 401k at work. They offer me a 401k work. I don't know how it works, but I'm putting money away. Or because I heard that too as well. And I was like, good for you. But you know exactly how it works. And that is when I explained them. This plan, it is tax deferred too as well. Again, you don't pay taxes now, but you will pay it whenever it starts distribution.
And why is it called a 401k? It's a little trivia question. Do you know why?
No, not to be honest.
It's line 401, section K of the tax code. Same as 403B is line. Yeah.
It's like somebody. So one of my accountant asked me the other day, what is a 409P in there, and that was for 408P or something like that. And I was like, what is a 408P? And I was like, let me look it up really quick.
Line 408P of the tax code.
Of the tax code, which is a simple IRA.
Yeah, absolutely.
So that is what it means, but they have different names. But the tax treatment and things like that is pretty much the same. So 401ks, and I'm gonna talk a little more into details into this because 401k and 403bs, they have, I would say, 90% of the same restrictions and particularity in the planning. The difference that 403b, it is made for employees of nonprofit organizations that works on public education, hospitals, governments, church, and things like that. So it is pretty much another way to say this one is a 401k, but just for these entities. Okay.
Yep.
So that's what we're going to talk a little more into the 401k.
Latin chamber, too late.
The university, we got one. We got one.
We can help them to set up. We can help them to set up one.
Too late.
So 401k. So again, as I was telling you, this one is a tax deferred. We have pre-tax contributions that this one helps the employees to reduce the taxable income in here. So that means that this money, it comes out of directly from your check and it goes straight to this plan. So you don't report this one on your taxable income in there.
Gotcha. Okay.
Then here's one of the plans, and this one is up to the discretion of the employer. They can decide to make some contributions. They can decide to make no contributions and just set it up for the employees, or they can say like, hey, I will match you dollar for dollar up to this amount. So it's up to their discretion and depending on how they structure this plan.
Okay.
They also have what they call cliff or restrictions that in order to enjoy these plans, you need to be with us a certain amount of days or a certain amount of times in order to start contributing into this, or in order for us to start contributing under your name.
Yes.
What is the advantage for the business owners? They can deduct all those contributions out of their growth.
Out of their gross.
That's the point for entrepreneurs. That's the point.
Correct. So that's what it is. So this one, again, is one of the restrictions similar to the one that we talked about before. That this one, they have to provide these benefits to anyone that is 20 years old in the company in there, and it has service at least 1,000 hours in 1 year. Okay, but this one, but this one varies from company to company. Okay, we have some companies that they tell you, hey, in order to enjoy this package of benefits that you have 90 days to do so, or you have 6 months. At 6 months, all these benefits will kick in, or you're going to be able to contribute into the 401k. Others than that, they stick to this rule that it says like, hey, I'm going to try out for a year. If you're still faithful to me, I will give you.
Then you kick in.
They will
with
kick you the 401k. So it is up to their discretions, but they have to do it for everybody. Okay. That includes highly compensated individuals. That is a different part that you can do in there too as well.
Okay.
So, and that is different income restrictions as well too.
Okay.
That you can do. The contribution limits for this year on 401k contributions are $20,500 per employee. Okay. If, say something, we set up a 401k as a business owners, we can contribute as employee because we're on payroll, right?
Yeah.
We can put $20,500 for us.
Okay.
We can match $20,500 for your employee. Say something, you're a solo employee or you're a partner or you have some other individuals that they're
you can put $20,500 in yourself. Match it.
$20,000, and as a business owner, guess what? You can put another 20.
$60.
So
that's important.
So
right there.
yeah, correct. So a lot of people don't know that too as well. And this one, it has a limit. What is that limit now? It is 25% of whatever money you make throughout the year, or up to $61,000.
That's a magic number right there.
Okay, but here is the thing. This one also has the catch-up contributions is what they call.
Okay.
So you can put even an extra $6,500 into these plans. So now instead of 20, you can put 27.
So the bottom line is if as a business owner, you may be listening to this going, Mike, I tell you, we're putting all our money back into the business right now. I don't know how I'm going to retire. Eventually, you're going to have a windfall of cash in some aspect. And when that happens, you need to call a guy like Walter to set one of these up for you, because if you are sitting on cash, you're going to just get taxed on it, number one. You can do something with it and plan for it, and then plan for your future a little bit better.
That is correct. So here's one thing too as well, and that's what we're going to talk about non-qualified too really quickly on there. 401ks, if they have not established one, sometimes we need to outweigh if it's worth it to pay into one, or if it's better to go a different route. What do I mean with this? In order to set up a 401k, okay, it can be very expensive. Okay, just recently I opened up a 401k for one of my clients, and just right off the bat, he has to pay $1,900 just to open it. Okay, wow. And after that, they had to pay somebody to give you maintenance to this plan. Okay, that is usually anywhere between $800 to $900. and that is not included whatever you put inside of the plan.
Okay.
So that means another cost that you have to pay in order for a financial guy to handle it,
To manage it.
to manage it.
Now, usually those costs are spread across, 1,000 individuals that are in a plan, right? Sometimes.
Sometimes, so that's what I said. Like, it
So
all depends.
you may have to foot the bill for the whole thing.
If you're doing it for yourself,
Yes,
you know,
yes.
or if you're doing
That
it for
makes
one
sense.
or two. So that's what I said. Like, if it's maybe 1, 2, or 3, let's see what options do we
Mm-hmm.
have. You know, see if a 401k, it is one way that you can put in there, or maybe a simple, or maybe a SEP, or maybe you're starting and you're good with just a regular traditional
Exactly.
IRA. So it is different routes that we can take. And as I explained you earlier, the 403b, it has the same limits contributions.
It's like a 401k.
It's the
pretty
401k,
much. Mm-hmm.
but just for these entities that I mentioned it before.
Walter, what's happened? Because I remember my 401k on 2006, it converts to 101k because the pension funds lose a lot of money on the market and .com and all those markets. So they lose the money on those pension funds. What is the best way to keep your money? Because it's your money. Where the money goes, not to the market, nothing. Yes, sitting somewhere else that is secure, is safe, and I know it's money, and I want that. I don't want my money be on the market.
Correct. We do have some other options. We do have some other strategies that we can use, but everything is going to be based on how much of a risk you want to take. You already told me that you are one investor that it doesn't want probably the volatility in the market or the uncertainty that it can change. But over a track history of the last 20 years, we have experienced a lot of up and downs, but we still came up with 7-8% return if we invested properly in discipline.
Yeah.
Okay, if we're invested in the long run, if we're invested in the long run, most of the time, like 85% of the time, the market is up.
Yeah.
It's not guaranteed. As it's not guaranteed, say something like you're going to retire when the market is up. How do we pretty much outweigh these different variables?
Yeah.
Put in different stuff at risk and be more conservative.
I think in general, I had a lot of friends call me during when the recession hit.
Oh yeah.
And they said, Mike, you went to business school. My retirement plan has lost half its value like overnight. I should sell and get out of this, right? And I said, no, don't sell.
Oh, yeah.
Because you're still employed. You're still buying. You're actually buying at a discount now. So just continue buying at the discount, leave it alone. And I had some friends that left it alone. And then in 2012, 2013, it all came roaring back, right?
Yes.
And I had other friends that sold everything and then were like, oh, I missed the market and all that. So dollar cost averaging over a longer period of time, we invest in a lot of mutual funds, right?
Oh, yeah.
A lot of these are targeted funds for certain targeted dates, and it spreads your risk out quite a bit.
That is true. And it's following that, piggybacking what you said, is like I have a lot of clients calling me when this COVID mini recession happens, because let's call it as it is. It was a mini recession. What happens? In March 14, we saw that the market went down 29.7%.
Yeah.
I have people calling me and telling me, Walter,
Sell everything.
put it in something like fixed. I don't want this fluctuation. And I told them, like, hey, do you know that this one, it is paper money, right? Are you planning to sell this one tomorrow? Or we still have 3, 4, 7, 10 years.
You got 12 years till you retire.
Correct.
Just chill out, leave it alone.
Yeah.
Right?
So that's what I pretty much tell. Some of them, they told me, Walter, no, I put it safe. Some others, they tell like, hey, you know what? I'm going to follow your advice. Guess what happened a month later? It came back up. 32%.
Yeah.
So all these people, they get out of the market. They lost the opportunity to buy when it was a discount.
You shouldn't buy low, sell high.
Correct.
All
Yeah,
right.
that's
Just remember that helps, right?
Correct.
So,
So that's pretty much
The problem is to be on target.
exactly.
You
gotta
sell
do
on
that.
this guy.
You got to do that.
correct. So
We have a couple more minutes left, but let's talk really quickly. My favorite vehicle of them all is the Roth IRA. I tell everybody and their mother, you need to have a Roth IRA.
correct. So that is considered a non-qualified plan. And what does this mean? That the non-qualified plan, it is a money that has already been taxed. What does that mean? That you invest in your retirement out of your bank account and not from your paycheck. Okay? Some of the advantage that these type of plans give you, like which example, the Roth IRA, that the earnings that you do in there or the growth that you do in there, if you're disciplined enough, it come out tax-free. Tax-free.
Yes, it's true.
Okay.
Yes.
What is a little bit of a downside? That the contributions are not deductible. Well, let's go back to the
It's like a savings account that pays interest, and when it pays interest, that's not taxable either.
Correct. So let's go back to the beginning of the conversation. What do you prefer to pay taxes on? You prefer taxes on the seeds? Or you prefer taxes on the orchard whenever you waited 20, 30 years? So that's a way that a lot of people relate to. And like these ones, there is like 2 or 3 other vehicles that they work really good. Here's one of the things that a lot of people don't know. A lot of people tell me, and I tell them, a majority of my customers and clients, invest on this one if you can. But sometimes that is restrictions on this. If you're making too much money,
You can't do it.
you can contribute into this.
Yeah.
What does this mean? If you're a head of household or you're an individual and you're making more than $125,000,
You're excluded.
IRS will tell you,
Nope.
you're making too much money. I'm not gonna allow you to.
But if you're married, Carlos, it's like almost $200,000.
$198,000.
Yes.
Correct.
Hey.
Wow, I can see a benefit now.
You see the benefit now? That's
The
good.
only one, the whole conversation.
So and here's the thing though. But say something that we're making a good amount of money and we're disciplined enough and we don't have that much debt. Again, the limits for an individual retirement account, it is $6,000 for a single, or if you're over 50 years old, it's $7,000. For some people that they're making a good amount of money, they tell me, Walter, I mean, yes, it's a great vehicle. Yes, I can contribute, but I want to contribute more. What are my other options?
Yeah.
You know, and that is when I tell them, like, hey, let's go back to square one and let me tell you what is your situation. So this one, it is a great investment vehicle, but it is the same as the regular IRA or the traditional IRA as they know. The traditional IRA, it is if you're a spouse, it is a non-working spouse, or it makes less than $6,000, you as a breadwinner, you can still open what it's called a spousal Roth IRA. So you can put $6,000 or $7,000, but again, you're funding that out of pocket.
I see the money flying. That's the only thing I see.
Correct. So another great vehicle in here that it is not very common, and these ones are ways to that some of the business owners, when they want to put a lot of money away, it can work for them. If pretty much say something, they need some sort of protection. And what do I mean with protection? And I will tell you really quick. We have what it's called variable annuity.
Okay.
Yep. A variable annuity, you won't owe tax on the amount that you pay into the annuity because it already comes out of your pocket. It already comes out of your bank account. The growth on this vehicle is deferred, so you don't have to pay taxes on the growth of this vehicle. But when you're taking the money out, you're just gonna take money out on the growth.
Okay.
So say something, you put $100,000 in there and that account grew to $150,000. You're going to pay taxes just in $50,000 out of that.
Never on the principal.
Never on the principal because that already came out of your pocket.
And this is very popular if, for example, you get a settlement from like an auto accident you were in and you get $2 million. So instead of taking all that money, you take the $2 million, you buy a variable annuity with it, and then you can live off that interest that comes out.
Correct. That will be one way to put it, but also the IRS tells you, hey, because we're giving you all this tax deferred growth too as well, we're not going to allow you to touch this one without any penalties until you're 59 and a half.
Okay.
If you do so, it comes out in a sense that is called a LIFO basis. What is a LIFO basis? LIFO means last in, first out. So what is the last money that it got to that account? Your growth.
So that comes out
So
first.
that comes out first.
Okay.
And that is if you do so before 59 and a half, guess what? IRS, it tells you like, hey,
You got to pay
you
something.
have to pay me the penalty on that too as well. But here's the plus too as well. That is no limits on contributions. So
That's awesome.
you can put as much as you want as long as it makes financially sense to you,
Okay.
and also to the company that helps you to do that. And another non-traditional way that a lot of people invest, that they don't want to take much risk and they need the protection. Okay, it is one tool that is called a cash value life insurance. So it's a life insurance that accumulates cash. Why it is important there? Because the contributions that you do are after tax and it has no limits.
Okay.
That's one thing. This one, it can provide you with a guarantee or an increased tax-free death benefit.
Okay.
Okay, so you can do that one to them. On these vehicles, you also have access to this accumulation with no penalties. And usually when this money comes out, depending on how do you plan it to take it out, it comes out tax-free. Okay. Other thing is that also grows tax defer onto this one too as well. And one of the sweetest things that we have here in Nevada, okay, is this type of vehicles, it is protecting you from your creditors.
Yeah. It can't be attached in a lawsuit.
Correct. And that is one
Awesome.
of the things that I discovered shortly too as well, because I have some clients in California. I do have different licenses in different states. They told me like, Walter, I had to sell my cash value life insurance that it was doing phenomenal, but I needed to declare bankruptcy because my business didn't work.
They can't touch it.
In California, they can.
Oh, in California they can?
Yes.
Oh, gosh.
So
That's why we live here.
That's
so
why.
that's what it says. Like Nevada is one of the sweetest one. It is just 13 states out of the 50 that it is creditor protectors on this vehicle.
Home means Nevada. Yes.
Yes.
So that
Yes.
because of that reason, cash value life insurance in some cases it can make sense.
can make sense
for
in
some
other-
people and for some not. So
Walter, great information today. This is excellent. If you're listening to this, you're a small business owner, you're like, boy, I need to plug into this. How do they get in touch with you, Walter?
that is a different ways that they can get in touch with me, but I always recommend to give me a call to my personal cell phone number, which is 702-280-6962, or they can visit my website, which is www.newyorklive.com/agent/W Flores.
Okay. Thank you very much for being on with us here today. Appreciate all the great information and answering all our questions, and you're a wealth of knowledge. So thank you.
Sounds
Thank you,
good.
Walter.
Thank you very much, guys.
And Carlos,
Wonderful.
thank you for being here with us today, and we're grateful for the Latin Chamber and for all you guys' help. Appreciate that. This has been another episode of the BizLife Podcast. Some great information here today about retirement planning. Let's go have a great day in your business today, and thank you very much. Have a good day, you guys.
Thank you. Have a good day, guys.